Hey, you did it, Yvonne. Good job. All right. So if you guys have a question, what I'll do is we're going to blow through these next two chapters, and then I'll stick around for anyone who wants to ask any question at all for a little bit. And then the other thing I'm going to do is hold another office hours on Saturday morning, but this time I'm going to do it through discussion board. So I'm going to open up a new discussion board because I want to make sure you guys, if you have questions, you have some time to ask them. And I also encourage you, of course, to ask your classmates questions about homework in particular. That's kind of free game as far as I'm concerned. There's no academic dishonesty policy with reference to homework. Like, because I know the solution manuals are out there. So some of those questions, if you just type them into Google, it will find you the solution for them. Obviously, that defeats the entire purpose of doing the homework. But I think working with other people sometimes is helpful. And I know some of you know each other, so you might consider doing that. Anyway, let's get on with chapter 12. Okay, let me close this little box. I'm always interested to know what's showing up on your end because I have no idea. One of these days I'll sit in on one of these that someone else is doing. So our learning objectives for 12 objections or objectives for 12 are two things. The first is we're going to discuss and explain the implications of compensation, right? So, and we're going to do the easiest part. We're not really going to cover any of the stock-based compensation. So that's good news. And then we'll look at non-taxable fringe benefits again. So it never hurts to cover fringe benefits one more time. I must love those things. All right, employee salaries and wages, the taxability of those is largely handled by the employer, right? So here's another area where we have this crossover between individual and business. And even though this course is mostly about business, you know, we got to do it. So income taxes are withheld from pay, right? And we'll talk about that more in a little bit. That's done by your employer. And employment taxes also withheld. So anyone who's worked here in the US, you know that those things are just handled by your employer. Then your employer is going to reconcile your wages and your employment taxes. So there's a series of payroll tax forms that they have to prepare and remit. And then they pay over your income and employment taxes to the taxing jurisdictions, either federal or state. So this is what I mean. Largely everything's handled by the employer. And then at year end, they have to provide information to you as an employee. They're required by law, if they've paid you wages, to provide you a W-2 at the end of the calendar year, usually I think by January 31st or something like that. And on there, they report your taxable wages that they determine, your Social Security wages, your Medicare wages, plus all the withholding that's been taken from you during the year. So really, when you think about it, the wage system, the tax system is largely handled by your employer, and all you do is report some of that information on your tax return. So it's just a transfer of information. So Charlie's salary is $50,000. And Charlie's going to elect to contribute 10% of his pay, or $5,000, to his 401k plan, his company's 401k. So just to understand how there can be differences, the amount you contribute to your 401k account for retirement is tax-free. You do not have to pay tax on that amount. That's incentive for you to invest in your own retirement. As a result, your taxable wages, Charlie's taxable wages, would only be $45,000. However, employment taxes are on all of that income. So on the employment tax box, on box 3, they would actually report $50,000 of wages. And I only point that out to you as an example of how those things can differ. So this is what a W-2 looks like. This is an old one, but the new ones basically look the same. You can see I've circled a few of the key things, like box 1, there's your taxable wages. Box 2 is the amount of income tax withheld. Boxes 3, 5, 4, and 6, or 3, 4, 5, and 6. Those are your employment tax related things. They don't really go on your income tax return. That 401k item that I talked about, you might see that on line 12. And then you see state wages and state income tax withheld on 16 and 17. So that's the reporting form, and they call these informational forms that you use to then prepare your own tax return. So withholding is a little bit of a mystery to a lot of people, which is amazing to me. But hopefully you'll walk away from this kind of understanding a little better. So the amount that's withheld from your pay is based on a form that you provide to your employer. So they give you a form W-4, you fill it out, you give it back to them, they withhold based on what you put on that W-4. And typically that W-4 has some questions on it that has you derive an estimate of what your taxable income would be if it were based solely on those wages, and those wages were paid for the entire year. So what that means is you're going to fill out your W-4 and it's going to say, oh, here's the number of allowances I want you to withhold on. And the number of allowances doesn't tie to the number of people in your household. So if you're married filing joint and you have 3 kids, that doesn't mean you're going to use 5 allowances. You may use 2 allowances. You may use 7 allowances. It depends on a lot of things, and I'll show you the W-4 in a second. The W-4 is within your control as an employee. If you want additional amounts of tax withheld, you can fill out another W-4 and your employer will withhold additional amounts or less amounts if you want. Okay, so income tax withholding is not an exact science. So what happens is based on the information you put on the W-4, your employer looks at your income and calculates the withholding. That's not intended to match exactly what your tax is going to be at year end. And so, in fact, they're designed to give you a little bit of a refund. Now, it doesn't always work out, but that's the design, is that you should get a refund at year end. And that's because the IRS would rather give you your money back than come asking for you to pay it, because you're far more likely to have it around if I have to give it to you than if I have to squeeze it out of you. So here's what a W-4 looks like, and we're not going to go through this in detail, but you can see the items A through H. Those are all ways that you calculate those numbers of allowances. This form is generally not turned over to the IRS. It's for your employer to keep a record of what you said you wanted withheld from your pay. There is a second page that has a more detailed calculation if you want to go through that. Okay, so employer considerations for salaries and wages. Generally speaking, salaries are deductible, and they're generally deductible when they're paid, right? So employers computing taxable income under the cash method of accounting, deducted when paid. Accrual method, deducted when the employee earns the wages. So accrual method allows you to accrue the costs at year end, right? Because typically your employees don't wait very long to get paid. So compensation expense can be accrued at year end so long as it's paid, 1, to an unrelated party, we talked about that earlier, and 2, within 2.5 months of year end. So think about the language I just used. Most employees aren't going to stick around if you don't pay them fairly quickly. So what that means is if you accrued compensation cost at the end of the year, but you haven't paid it within 2.5 months, it's a pretty good bet that's not a legitimate accrual. And as a result, the IRS isn't going to let you do it. So Lutfula, I apologize if I didn't say your name right. You're using the post-it method too. If you go into Zoom and click camera off in the bottom left, it'll actually turn your camera off if you want to. You can leave it on. It's up to you. Okay. So the after-tax cost of providing the salary is generally much less than the before-tax cost, because the after-tax cost of a salary is your pre-tax times 1 minus the tax rate. So if XYZ pays one of its employees $80,000, XYZ's in the 21% tax bracket, what's the after-tax cost? Well, it's $80,000 times 1 minus the tax rate, or $63,200, right? So you can see that by deducting a cost, the federal government is actually helping you pay for it because it's reducing your tax liability otherwise. There are limits on salary deductibility. So the first is the reasonable test, right? And we talked about that back in chapter 9, where we said in order to be deductible under 162 or 212, it must be ordinary and necessary. And we said one of the characteristics of ordinary and necessary is that it is a reasonable amount. And again, typically that only gets mixed up if you have related parties. There is another limit, however, as well, and that's the $1 million annual compensation deduction per person. So if you are a public company in the US and your compensation exceeds $1 million, your company can only deduct up to $1 million. And that applies to the CEO, the CFO, and the 3 other highest compensated officers in the company. So pre-2018, that didn't apply to performance-based comp. So what would happen is everyone received $1 million salary and everything else was considered performance-based. However, the Tax Cuts and Jobs Act for 2018 and thereafter, this limitation applies to performance-based comp as well. So let's see what that does. So All American Burger is a public company. It pays its CEO, Dennis Taylor, $900,000 of salary, and it pays him $700,000 in performance-based comp. So if you look at 2017, the total pre-tax cash outflow would be the 900 plus the 700, 1.6. His deductible salary is 900,000 because that's less than $1 million. The performance-based comp was not limited at all, so he could deduct all 1.6, or ABC could deduct all 1.6. There was a 35% tax rate on corporations then. His tax savings was 560,000. So the after-tax cost was $1 million. In 2018, however, the pre-tax cash outflow, we'll assume, is the same. The salary is deductible to $900,000, but he can only deduct, or ABC can only deduct another $100,000 before they're at the $1 million limit. The tax rate's been reduced to 21%, which means the tax savings is $210,000. I'm not sure what that number is, but it should be $1.9 million. So that's $1.9 million that can be is the after-tax cost. So you can see the after-tax cost of that compensation has gone way up as a result of changes to the tax law. Hey, Grant, if you want, if you go into Zoom, you can mute your camera on that setting. So in fact, in retrospect, what I ought to do is cut a video that shows you guys how to mute your camera on video. It just says stop camera if you go into Zoom, and that'll turn it off for you if you want to. Otherwise, you can stay on camera. It doesn't matter to me. All right, so the second part of Chapter 12 is all about fringe benefits, and we've talked about these before, right? Employers can provide non-cash benefits to employees in addition to their cash compensation. So if, for example, your employer pays for your health care, or they let you use the corporate aircraft, all those things are plausible non-cash benefits paid to your employees. The general rule is they're taxable to you, right? So gross income, all sources, whatever derived, however paid, including fringe benefits. But there are qualified fringe benefits and taxable fringe benefits. The taxable ones, well, that's like any other compensation, right? You treat it, whatever the value is, like you received it in cash. The employer is going to deduct the cost. They're going to pay the employee's share of FICA taxes, et cetera, et cetera, et cetera, right? That fringe benefit is totally taxable. And it's like the example I gave earlier of if they paid for you to go on a trip to Hawaii because you hit the sales quota. If you're an employee, you may still want to participate in a taxable fringe benefit. One of the reasons is because maybe as a result of purchasing power, you can get it for cheaper. So a great example is life insurance. It is actually quite inexpensive often to join the group term life insurance that your employer provides. That's a taxable benefit above $50,000, but maybe you can get a rate better there than you could anywhere else. And so as a result, sometimes people use the taxable fringe benefits as well as the non-taxable fringe benefits. Okay, so as an example, let's do the tax thing. And let me point out to you, you are not responsible for this specific tax rule, right? This is more of an individual deal. Employees must recognize a certain amount of gross income when the employees pay for life insurance premiums with a death benefit in excess of $50,000. So your employer can buy you up to $50,000 worth of life insurance. The premium they pay for you is deductible to them. You don't have to include that as compensation that's taxable. If, however, it's in excess of $50,000, now you have a taxable benefit. So the first thing you do is you figure out what's the amount in excess of $50,000. You do a little calculation on that, use a table, and you get some amount that you actually have to include. And what's going to happen is your employer is going to include that in box 1 of your wages as taxable income to you because they're paying for life insurance in excess of $50,000. There are a number of non-taxable fringe benefits. I'm not going to redo these after Chapter 5. We covered the biggies for sure, but you can definitely go through the book and read some more of these if you'd like to. Okay, so let's say an employer offers to reimburse an employee $200 a month for their parking costs. What amount of this reimbursement would be a non-taxable qualified transportation fringe? So in 2017, all of it would be a qualified transportation fringe because the rule says that an employee can exclude up to $250 a month in 2017 of qualified parking. So none of the $2,400 that you're reimbursed is taxable to you. In 2018, the rules did change. So first off, it went up to $260 a month because that amount is adjusted for inflation. But the deductible amount of the transportation fringe was repealed. So what that means is if an employer provides qualified transportation fringe to their employee doesn't have to include it in income. However, the company does not get the deduction. So just to be clear, so we know what's changed between 17 and 18, because these are things that are going to differ in your book. The bicycle commuting fringe, I don't even know if that's in your book. That was one of my faves. I never bike to work, but I thought, man, that was good tax policy, right? To try to get people to bike to work. Anyway, your employer could pay you a little bit to cover some of the cost of biking back and forth to work, and that income was excludable. That's no longer the case. That's gone. Moving cost reimbursements used to be excludable. If you had to move and your employer reimbursed you for the move, that used to be excludable. That's no longer excludable, and Armed Forces is accepted. 50% deduction for the convenience of the employer meals and meals on employer premises. That used to be 100% deduction. Now it's down to 50. In 2026, it goes to a 0% deduction. And there's no deduction for parking or public transport costs, right? So again, if you use that as a fringe, if you reimburse your employees, the employer gets no deduction for those items. All right, that brings us to the end of Chapter 12. We're not going to take a break. We're just going to go right into Chapter 14 and hopefully finish this. For those of you that have been listening for a long time, you know that my 12-year-old forgot his lunch today. He's probably going to be eating lunch down at middle school soon. I need to get it to him. He also forgot his bus pass, for that matter. In any event, none of that really matters. Chapter 14 is about using your home as a business. So most of this chapter is devoted to this notion of all the great tax benefits you get from owning a home in terms of being able to deduct mortgage interest, being able to deduct property taxes, being able to exclude the gain on the sale of your home. That's all 503 material. We're focused on this idea of using a home as a business. And you can do that either full out as a rental, you can do it part-time, or not at all. And we're going to talk about those classifications. So whether a home's considered a principal residence or just a residence or a non-residence, we'll talk about what those definitions are. We're going to talk about the tax issues and consequences associated with the rental use, right? So if you've been watching for a long time, you know back in Chapter 9, we covered Schedule E. This is basically a coverage of Schedule E. And we're going to describe the requirements necessary for a home office deduction, because that's another way you use your home as a business, is you have a home office. Okay, so a dwelling unit is a home, and believe it or not, a home can be, of course, a home, a house. It can also be a condo. It can be a mobile home. It can be a boat, right? If your boat has a kitchen and a bathroom, qualifies as a dwelling unit. So your home could be used solely for personal use. That's what most of us do, right? Most of us that own a home use it solely for personal use. It could be a mixture of personal and rental use, or it could be solely for rental use. And we're going to break those down because those categories are important. Because whether a dwelling unit is a residence or non-residence for tax purposes depends on how it's used. And the three categories we need to define, which I've used as my examples versus the book's term, is the first one's primarily personal use. And the book calls that a residence with minimal rental use. The second one I call in between, and that's a residence with significant rental use. And the third one is primarily rental use, and the book calls that a non-residence. So if you think about it, my categorization is it's primarily personal use, or it's primarily rental use, or it's something in between. That's why I use those terms. So the reason we care about that is it's going to change the way we recognize income and deductions for the business use of this home. So let's start by calculating what is personal use versus what is business use. So personal use is if I'm in the home, if I put a relative in the home, even if that relative is paying fair market value. So this is a classic case of I own a vacation home and my sister decides she wants to stay in the home, and I'm a cheapskate, and I'm like, yeah, you can stay there, but you're paying me rent. Even if she pays me rent, that's still considered personal use unless I rent that home to her as her principal residence, meaning that's the home she actually lives in and stays in all the time. So days as a non-owner when I'm under vacation, home exchange, or swap. So obviously, if I put someone else in my vacation home under a home exchange, that's personal use. And days I rented out for less than fair market value, that's personal use. So days I rented out for market value, that's a rental day, or days I spend repairing or maintaining it for its rental use, those are rental days as well. Okay. So days when the home is available for rent but not rented, those aren't personal or rental days. Those are like days that don't exist at all. I guess they have Dr. Strange's gem and they can use it to go back in time or something. All right, so a couple of individual tax rules we need to understand before we engage in this. And we'll just do them superficially, but we need to understand them because they're going to play a part when we get to the business part. So the first is mortgage interest paid on debts secured by your principal residence are deductible as itemized deductions. So what that means is I own a home, I have a mortgage on that home. The interest I pay to the bank, I can actually deduct individually. Real property taxes on your principal residence are also deductible as an itemized deduction. Now, there's a lot of kerfuffle, especially here in California, because taxes in total are subject to a $10,000 annual cap. But neither here nor there, you can still deduct up to $10,000 of your real property taxes as an itemized deduction. And so the reason those are important is what that means is we can take those deductions whether we use that home for business or not. And by the way, again, this is outside the scope of this course, but a second home also qualifies as a residence for purposes of those two deductions. So you can have two homes and deduct the mortgage interest on two homes. You can have two homes and deduct the property taxes on two homes. It's only that third home. God forbid I find myself in a position where I have a third home. Mo money, mo problems. I wouldn't be able to deduct that cost. This is important because we're going to bifurcate, as I said, these deductions into a personal use part and a business use part. So let's start with category one, which is primary personal use, which is residence with minimal rental use according to the book. So in this case, the taxpayer has to have lived in the home for at least 15 days, so more than 2 weeks, and you have to rent it out for 14 days or less, so 2 weeks or less. If this is the situation, all of your rental income is excluded. It's not deferred, it's just excluded. And all of your rental expenses, except those that would be itemized deductions anyway, the things we just covered, they're non-deductible. So Mr. Hand owns and lives in a condo in Atlanta, and it's located within walking distance of the Mercedes-Benz football stadium. In January of 19, Mr. Hand is going to take a vacation to Hawaii. And during that time, he says, you know what? I'm going to rent out my condo because that's Super Bowl week. And because it's Super Bowl week and the Super Bowl is in Atlanta, I'm going to get $4,000 in rent. That rent's going to pay for my entire vacation. Because Mr. Hand lives in the home for at least 15 days, because that's just his home, his rental is less than 15 days, so it's 14 days or fewer, that $4,000 is tax-free. So he does not have to declare any of that income. He doesn't have to recognize any of that income. Now, to the extent Mr. Hand pays for a cleaning fee or some other costs associated with the rental, those expenses are also not deductible. So for example, if you have to place an ad and he had to pay for that ad, he wouldn't be able to deduct that cost. But he can deduct, of course, his interest and real property taxes as an itemized deduction if he could otherwise. Okay, let's do category two, which I call in between. which is a residence with significant rental use. So how do we define in between? So the first is, well, we got to get out of category 1. The way we get out of category 1 is we rent that home for more than 14 days or 15 days or more. Our personal use, so what this means is we have to have some personal use, and it's got to be the greater of 15 days or more than 10% of the total fair market value rented days. So basically, we're splitting up the number of days I used it, either for personal or for rental. And I had to have some significant rental use, but I've also had to have some significant personal use. So in this case, we of course include rental revenues in gross income, and we're going to allocate our expenses between personal use and rental use. However, if the property is used for even a day of personal use, we have to do that allocation. Even 1 day of personal use forces us to do the allocation. The other thing we have to do is we have to categorize our expenses as a tier 1, tier 2, or tier 3 expense. So tier 1 expenses are the expenses we incur to get tenants, so our sales cost, and interest and property taxes. More technically, it's things we could deduct elsewhere. Tier 2 is all the other rental expenses except depreciation, and tier 3, therefore, is depreciation. The reason that's important is we can only allocate expenses to rental use to the extent of the rental income. So let me put that into different terms because those are the book's terms. I can't allocate more expense than the gross rental revenue that I received. I can't have a loss from an in-between categorized property. So the general rule is I'm going to allocate my expense based on the number of days used for personal over the total number of days. But there's an exception for the tier 1 cost called the tax court method, which actually lets me allocate based on the total number of days in the year. So, and expenses are deducted in tier order, and there's no other way to do this but through an example. So at the beginning of year 1, Mr. Hand and his family purchased a vacation home in Hawaii, right, for $400,000. They paid $100,000 down, financed the rest, so they have a mortgage. They used the home for 30 days, and they rented it for 200 days. Therefore, they got $37,500 in gross rental income. They spent $500 in advertising. The other expenses they incurred on this home are the ones listed there. So interest, taxes, utilities, repairs, insurance, maintenance, and depreciation. So we need to figure out how to allocate these costs and determine what Mr. Hand and his family will be able to deduct. So kind of the first thing we ought to do is determine whether they fit within the category 2, right? So rent home for more than 15, personal use greater than 15 or more than 10%. Okay, so let's see. Did they use it? Did they rent it for more than 15 days? Absolutely. They rented it for 200 days, right? Did they use it for more than 14 days and more than 10% of the days rented? Well, 10% of the days rented was the larger one. That's 20 days. They used it personally for 30 days. They're in the in-between category. Okay, so now let's go to the allocation process. So I've listed all their expenses on the left in tier order. So tier 1, advertising, right? That's sales to get tenants. Interest and property taxes. Total tier 1 expenses are $23,500. Then my tier 2 expenses, utilities, repairs, insurance, maintenance. Total tier 2, $13,000. Then I have depreciation of $13,939. That's the only thing in tier 3. My total expenses are $50,439. Well, I'd love to deduct all $50,439. That would give me a loss if it's not subject to the passive loss limitation rules. I can use it to offset my income, lower my taxes, et cetera, et cetera, et cetera. But as an in-between category, my deduction has to be limited to the total gross rental income. So the first thing I do is I'm going to allocate. So I'll use the IRS method. The IRS method says take the rental days over the total use days. So I used it 200 for rental, 30 for personal. My pro rata share is 200 over 230. I apply that to every item except advertising because that's a direct cost. That's not an allocable cost. There's no personal use to that advertising. I didn't advertise so I could be in there. Everything else is allocated. Interest, I take 200 divided by 230 multiplied by 18,000. Taxes, 200 divided by 230 times 5,000. And I work my way down the list. When I get down to tier 2, then I have to calculate how much have I already incurred up to tier 2. Because remember, I can't deduct anything in excess of what my gross rental income is. Well, when I calculate that, I get all the way to 5696. So even though my allocated depreciation is more than that, I'm limited in the amount of depreciation I can deduct. It's only 5696. That means my total expenses are only the 37.5, which means I can only deduct 37.5. The remaining depreciation is carried forward so that maybe I can deduct it in a future year. Okay, under the tax court method says, okay, you can use the total number of days during the year to allocate. And when you think about it, that actually makes sense. Okay, let me explain why. The bank wants their interest, whether I live there, whether there's a tenant in there, or whether no one's in there. The county wants their property taxes, whether I'm in there, a tenant's in there, or no one's in there. But in theory, I don't use any utilities if I'm not there or a tenant's not there. In theory, I don't have to pay for insurance if I'm not there or a tenant's not there. In theory, I don't have maintenance if I'm not there or a tenant's not there. Now, that's not entirely true, but that's the design behind the tax court method, which is why they approved this different allocation method. Again, you can only allocate tier 1. The 500 advertising, that's the same. I take interest, 18,000 times 200 over 365. I get the allocated result. I take property taxes, 5,000 times 200 over 365. I get the tax court allocated result. For all the other expenses, I simply use the IRS method. So that's the number of days rented over the total number of days used. That makes them the same as the other column. Then I get down to the bottom, I have to do the same sort of calculation. Can I absorb all of that depreciation expense? Well, it turns out I can, right? So now I do 200 over 230 times 13,939. That's 12,121. I can deduct all of that depreciation expense and still have a little bit left over. So you can see in this case, the tax court method might actually favor me. So let's think about what we did. What did the tax court method do? It allocated some of interest and property taxes away from the business. Why did that help? Well, it helped because now I could deduct all of the depreciation that I couldn't deduct before. And in theory, all my interest and property taxes are still deductible to me as an itemized deduction. So that's why that tax court method exists. All right, our third category is primarily rental use. So the book calls this non-residence. So think of this as, look, it's almost all rental because the rental days are more than 14 and my personal use is 14 days or less than 10% of the rental days, right? So what that means is I'm not category 1 and I'm not in between because I didn't use it enough for personal use. Okay, so in this case, the rules are great. It basically says, look, you're pretty much in this as a trade or business. We're going to let you deduct all of your rental expenses, right? Now, we're going to make you allocate them. So if you did have personal use, you have to go through the allocation, but we're going to let you deduct all of the allocated rental expenses. There's no limit. You can create a loss. That loss may or may not be deductible depending on whether it's a passive loss. So the book is a little bit confused about interest. So it says that if you have it for personal use and you incur interest, you're not allowed to deduct the personal interest part. And that's simply not true. If that home is your first or second home, then it is a residence and the personal interest can be deducted. It's if it's like a third home, then it's not deductible. Okay. So let's assume instead that the Hand family didn't use the home for personal purposes at all because it decided that, you know what, Hawaii's just too far away. And so they rent it out exclusively. They get the same 37.5, the same 50,439 of expenses. How much can they deduct? And this is before considering any passive loss limitation from Chapter 7. Well, they can deduct all of it. They generate a $12,939 loss that may or may not be limited by passive activity loss limitations. It depends on whether they're active participants in the management of that real estate. Okay, so let's assume that in year one, the hands incurred $12,939 of passive loss. They didn't have any other passive income. They are considered to be active participants, and their current year AGI is $140,000. How much of that loss can they deduct? Well, recall that there's the passive loss limitation rule says if your AGI is over 100,000, you start to phase out. They're 40,000 over the threshold. 40,000 times 50%, which is the phase out rate, is 20,000. They would have been allowed 25,000, but they have to phase out 20. There's 5,000 left to deduct. So they can deduct 5,000 of that loss. The remaining 7939 is suspended and carried forward until they earn more passive income. All right, our last item is the home office. So to qualify for a home office deduction, did I accidentally turn my sound off? Didn't want to do that. Let me turn my sound back on. Sorry, you guys. There we go. To qualify for a home office deduction, of course, you have to use your home or part of your home exclusively. Let me underline that, double underline it, triple underline it. Exclusively and regularly as either a principal place of business or a place to meet with patients or clients in the normal course of business. Okay, so that exclusive rule means exclusive. So I'm actually sitting in my home office. But if you can see, back here behind me is a bed. When we have guests stay in this room, they stay in this bed. As a result, I do not use this exclusively as a home office. I am not eligible for any home office deduction as a result. So how's the IRS know? I don't know. If they walked in here and saw a bed, I'd be bumming. Okay. So the self-employed deduct this as a 4 AGI deduction, and you'll see it on Schedule C, right? So if you're self-employed, you're a sole proprietor, you fill out a Schedule C. One of the lines on there is for the home office deduction. You take that deduction. If you flip back to Chapter 9, you can see it. If you're an employee, it used to be that you were able to deduct that as a miscellaneous itemized deduction. And miscellaneous itemized deductions are subject to this floor of 2%. Anyone who's taken 503 should know that. However, the Tax Cuts and Jobs Act totally repealed miscellaneous itemized deductions subject to 2%. As a result, home office deduction for an employee is no longer deductible. There are two methods, the actual expense method and the simplified method. So the actual expense method should look and feel very similar to our home rental with the in-between category. I have to allocate direct and indirect expenses, right? I do that sometimes based on square footage, maybe number of rooms. I have some reasonable method by which I allocate. And then my deduction is limited to the gross income derived from the business. So my home office deduction cannot create a loss. I deduct those expenses as tier 1, 2, and 3, just like I did for vacation homes. So the square footage deduction is way easier. It's simply $5 a square foot for the part I use as my home office, limited to 300 square feet, which means the maximum deduction is $1,500 for the year. I'll put it the same place on Schedule E. I don't take any depreciation expense. And I can choose from year to year whichever one I want. So if one's greater than the other, I can choose it that year. I don't have to use it next year. I can use whichever one's greater next year. So Allocate Costas operates a qualifying home office in her home. So that must mean she's using it exclusively for business purposes. The office takes up, let's see, I can't read it on mine, 275, and her home is 2,200 square feet. She earns only $1,400 of gross income from her business. So she's not doing too well, but maybe it's her first year. Her annual expenses associated with the home are listed below. So we would need to calculate the allocated amount. So how would we do it? We say, okay, her home office is 275 square feet. The total square footage of the home is 2,200. So I'm going to multiply each of those amounts by 275 divided by 2,200. So I take the pro rata share of electricity, the pro rata share of interest, the pro rata share of taxes. I do not have to take the pro rata share of repairs to the office because those are direct costs associated with only the office. The flip side to that is if I make repairs to the master bathroom that has nothing to do with the office, I don't even get an allocated portion of those because they have nothing to do with the home office. I can allocate cleaning, assuming the cleaning for the office is the same as the rest of the home, and I would allocate depreciation, again, based on the number of days. Now, one of the issues you run into is the same thing. I have to total my expenses before tier 3, see what they are, how much is left to deduct. Well, as it turns out, I can only deduct 100 of that depreciation because otherwise my total deductions exceed the 1,400, which was the gross income from the business. All right, that brings us to the end of the video lecture. Does anybody have any questions they would like to ask? Otherwise, I'm going to put this one in the books